According to a February 2026 BMO survey, the average Canadian now believes they need $1.7 million dollars to retire comfortably. So if you're sitting on a $2 million portfolio, you're already ahead of what most Canadians think they need. But here's the part nobody talks about. Having $2 million saved and actually living off $2 million in Canada are two completely different things. Because taxes, withdrawal order, government benefits, and inflation can turn that $2 million into a lot more or a lot less, depending on what you do with it. So let's break down exactly what retirement looks like with a $2 million portfolio in Canada right now in 2026. The first thing most people do is reach for the 4% rule. You take 4% of your portfolio in year one, adjust for inflation every year after that, and hope your money lasts 30 years. On $2 million, that gives you $80,000 a year before tax. Sounds comfortable. But some experts now recommend a 3.7% to 3.9% safe withdrawal rate for 2026, especially with bond yields still lower than historical averages. At 3.9%, you're looking at $78,000 a year. Still strong. But that's the gross number, and the government is going to want its cut. Here's where things get interesting. If you're 65 or older, you're also collecting CPP and OAS on top of your portfolio withdrawals. In 2026, the maximum CPP payment at age 65 is $1,507.65 per month. The average for new beneficiaries is around $925, and the maximum OAS for someone aged 65 to 74 is $743.05 per month. So let's say you're getting a combined $1,600 a month from CPP and OAS together. That's $19,200 per year in government benefits. Stack that on top of your $80,000 portfolio withdrawal, and you're now pulling in about $99,200 in gross annual income. That sounds like a great retirement. And it is. But here's the trap. The OAS clawback threshold for 2026 is $95,323 in net income. Once you cross that line, the government starts taking back 15 cents for every dollar of income above it. So at $99,200, you're already $3,877 over the threshold, which means roughly $582 of your OAS gets clawed back. Push your withdrawals even slightly higher, and that clawback grows fast. At the upper end, if your net income reaches $154,753 for those aged 65 to 74, your entire OAS benefit gets wiped out. That's nearly $9,000 a year in government money you lose simply because of how you structured your withdrawals. This is why withdrawal strategy matters more than portfolio size. Now let's talk about something that can save you hundreds of thousands of dollars over your retirement, where your $2 million sits. A $2 million portfolio split between an RRSP, a TFSA, and a non-registered account behaves very differently than $2 million sitting entirely inside an RRSP. Every dollar you pull from an RRSP or RRIF is taxed as regular income. At the 2026 federal level, the first $58,523 is taxed at 14%. From there to $117,045, you're paying 20.5%. And it keeps climbing. But money inside your TFSA comes out completely tax-free. It doesn't count as income. It doesn't trigger the OAS clawback. It doesn't push you into a higher bracket. The cumulative TFSA contribution room for someone eligible since 2009 is now $109,000. If you're part of a couple, that's $218,000 sitting in a tax-free shelter. On a $2 million portfolio, that TFSA portion is your most powerful tool. Then there's the non-registered account. Gains here are taxed as capital gains, and thanks to PM Carney's cancellation of the proposed inclusion rate hike in March 2025, the capital gains inclusion rate remains at 50%, so only half of your capital gains count as taxable income. Canadian dividends from eligible stocks also get preferential treatment through the dividend tax credit, where the federal credit rate sits at about 15.02% of the grossed-up amount. This means income from a non-registered account is taxed far lighter than RRSP withdrawals. So here's the real strategy. In your early retirement years, before CPP and OAS kick in, you draw down your RRSP aggressively. This is called an RRSP meltdown. You keep your annual RRSP withdrawals within the lowest tax brackets, paying 14% federal instead of letting that money pile up and get taxed at 20.5% or 26% later. Meanwhile, your TFSA keeps compounding tax-free, and your non-registered account grows with favorable tax treatment. By the time you hit 65 or 70 and government benefits start flowing in, your RRSP balance is much smaller. That means lower, mandatory RRIF withdrawals, less income on your tax return, and little to no OAS clawback. And speaking of RRIF withdrawals, once you convert your RRSP to a RRIF, you're forced to take minimum withdrawals every year based on your age. At 72, the rate is 5.40%. By 80, it climbs to 6.82%, and it keeps going up. If you still have a massive RRSP balance when those mandatory withdrawals kick in, you could be pulling out $100,000 or more per year whether you need it or not. That pushes your tax bill through the roof and could eliminate your OAS entirely. The RRSP meltdown prevents this. This one move, withdrawal sequencing, can add $300,000 to $500,000 to your after-tax estate over a 30-year retirement. Let's also talk about what you're spending. The average Canadian retiree brings in about $31,400 a year. For couples, it's around $64,300. With $2 million and government benefits, you could realistically spend $85,000 to $95,000 per year after tax. But your spending won't stay flat. Most retirees spend more in their 60s when they're active and traveling, less in their 70s, and then expenses may rise again in their 80s due to healthcare costs. A smart plan accounts for this curve instead of assuming the same number every single year. And don't assume Canada's public healthcare system covers everything. Once you retire and lose employer benefits, you're on the hook for prescription drugs, dental care, vision, physiotherapy, hearing aids, and mobility devices. A couple in their late 60s can easily spend $4,000 to $7,000 per year out of pocket on these costs alone. By your 80s, that number can double. Private health insurance for retirees exists, but premiums climb steeply with age. This is the healthcare gap most Canadians don't budget for, and on a 30-year retirement, it adds up to $150,000 or more. There's also a risk most retirees never think about until it hits them. Sequence of returns risk. This is the danger of getting bad market returns in the first few years of retirement, right when you're also making withdrawals. If your portfolio drops 20% in year one and you're still pulling out $80,000, you've now permanently reduced the base your money grows from. Even if markets recover later, the damage is done. A cash buffer of 1 to 2 years of expenses sitting in a high-interest savings account gives you the flexibility to avoid selling during a downturn. It's boring, but it protects your entire plan. One more thing that catches people off guard: inflation. Even at a modest 2% per year, which is close to where Canada sits right now, your purchasing power drops by about 18% over 10 years. That $80,000 withdrawal will only feel like $65,600 a decade from now. Your portfolio needs to keep growing to keep up. This is why retirees still need growth assets in their portfolio, not just bonds and GIC. A balanced mix of equities and fixed income gives your money the chance to outpace inflation while still providing stability. So what's the bottom line? Retiring with $2 million in Canada in 2026 puts you in an excellent position. You have enough to generate $80,000 to $95,000 a year in after-tax income when you combine smart withdrawals with CPP and OAS. You're above what most Canadians think they need. But the gap between a good retirement and a great retirement comes down to 3 things: where your money is held, the order you withdraw it, and how you manage taxes along the way. If this breakdown gave you clarity on your own retirement numbers, hit subscribe and turn on notifications so you don't miss what's coming next. Thanks for watching, and I'll see you in the next one.